China has been the market that everyone has loved to hate. You've had COVID lockdowns, regulatory crackdowns, property crisis. It's been a rough few years. However, there is signs that this may be turning. And in today's episode, we are asking the question, is China really back? Welcome to Equity Mates Investing, a podcast where we explore what is possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the show. My name is Bryce. Today, we are joined by Lukasz de Pourbaix from Fidelity. We're going to be digging into what's changed in China's economy and policy settings, where valuations and opportunities sit today, and whether this time is actually different. If you'd like to get exposure to the China thematic, you can do so through the Fidelity Asia Active ETF. The ticker is FASI. And a huge thank you goes to Fidelity for supporting today's episode. Without their continued support of Equity Mates, we wouldn't be able to keep all of our content free. Well, with that said, let's get into our discussion today with Lukasz. Lukasz, welcome to Equity Mates.
Thanks for having me.
So for the past few years, China's been the market that everyone has somewhat loved to hate. Property crisis, regulatory crackdowns, COVID lockdowns 5 years ago. Let's start generally. What's changed that makes you confident enough to say that China is back?
I think it's interesting because I think even if you step back and you think about how has the Chinese market performed year to date, so despite all of the negative news, and a lot of it is warranted, absolutely. But if you think about just the performance of the equity market, year to date, the Chinese market has actually outperformed the US market. And, if you were sort of to marry that up against the news and the negativity, a lot of people maybe wouldn't even think that was the case. Yeah. So the market has, I would sort of say markets generally tend to lead the macro data and so forth. So that's one. But I think in terms of what has changed, and I think that there's a couple of key things. And one is policy. So how China has actually approached policy. And we can get into it a little bit more in terms of some of the details. But I guess in a nutshell, they've been far more targeted in their policy. So if you sort of cast your mind back, years ago, a lot of the policy was let's just dump a whole bunch of money into and flood the economy with money, and you get a bit of a bubble, but that's sort of not sustainable. What we've seen this time round is a far more targeted approach to policy, which is point one. I think the other thing is macroeconomic stability as well, in terms of some of the fiscal stimulus that they've undertaken. I guess the key theme across both of those points has been a lot more measured this time round than other times, which have led to other things like the property bubble in the past and so forth. And then finally, if you just look at capital flows, generally, investors have generally been underweight China, emerging markets more broadly, but certainly part of that rationale has been a view on China, a negative view on China. But if you think about, forward earnings, it's sort of around the 9% mark. And it's trading about half of sort of more developed markets. So it's sort of an interesting dynamic where you're starting also to see some capital flows. I wouldn't say flood in, but I think what's happened is a lot of big investors are sort of saying, okay, maybe 2 years ago the question was why invest? Maybe where we are at the moment is when do I invest and how much should I invest? So there's also a bit of a psychological shift as well.
Well, hopefully by the end of this episode, you can help us answer that. So we will touch on policy and some of the key drivers that you discussed there. But for people that are listening who are thinking, I've heard all of this before, feeling a bit skeptical, what would you say to them? Why is this time, is it different? Like we have had some false starts before, particularly around, a few years ago when the government was pouring money in and, we've had some false starts. Why is this different?
It is different, but it's similar, okay? So I certainly it's not the case where, everything's rosy and we're off to the races. That's not the case. And to be frank, if everything is rosy and everything knows it, well, it's already happened, right? So it's, from an investment perspective, you're probably too late. But what you want to see is marginal improvement, particularly when you've seen a market sell off quite heavily, a lot of negativity in terms of news. What you want to see is not necessarily a V-shaped rebound in terms of data. You just want to see gradual improvement because the market just wants to see stability and improvement. And we're starting to see a little bit of evidence on that. And if you think about what has led to, what has driven some of that stability. And there's a couple of things. I mentioned policy activity before and how much more targeted it has been. So, for example, one of the tools they've initiated, I think it was in October 2024, was their swap arrangement where effectively they would take the government offered a swap facility where effectively you could swap sort of more liquid type of assets if you were sort of a government entity, a government enterprise, in return for liquidity, and that liquidity is then used to invest in the market, right? So it's a liquidity function, and what we do know is markets like liquidity, and not just in China, in every market. We saw that, back in the day when we had the quantitative easing programs in the States and in Europe. This isn't quantitative easing, but I guess the main thing is it's providing liquidity to markets, and it's very targeted. And it's important because it brings confidence to market participants, but also confidence to the general public, because that's been a big missing factor in a lot of years is confidence by the people of China. Yeah. So they copped property prices going down, which impacted a lot of households. And so there was a real nervousness around, okay, I've got money, but do I want to spend it, right? Yeah. So a lot of it is confidence. And that's the other point we're starting to see is that, the consumer, which, again, if you sort of go back in history and you think about that COVID period, everyone was banking that as soon as COVID's over, gates are open, consumer will come back and spend. That didn't happen, right? But what we are seeing now is that your general public is spending more on things like travel, is spending more on some of those more discretionary purchases. We're seeing that in the data. And on the property side, absolutely, it's still depressed. But I guess the key thing to look at is it getting worse? And the data suggesting that it's not getting worse. Okay. So we're not out of the woods by any means, but I think you've just got to sort of follow the picture of are things improving and is policy working? And to date, some of those targeted policy initiatives have increased some of the confidence in the market.
So, as you said, People's Bank of China introduced some, I guess, unusual tools. Yep. The swap facilities, there's re-lending programs.
Yes.
So, I guess, you mentioned like the importance of those to provide liquidity.
Yeah.
Can you just break them down further, what they actually mean, if there are any other sort of parts to the policy landscape that are really helping the market here?
Yeah, absolutely.
And also, like, is this just a Band-Aid effect, or is it something that is somewhat more sustainable?
Yeah, and that is a big question. Is it sustainable? So part of it, I'd say, is to elevate sort of shorter-term sentiment and liquidity in markets. So things like the swap,
people excited again.
Get the markets excited. Absolutely, there's an element of that. But if you look beyond that, there are more, I would say, medium, long-term structural things that have been initiated. So, for example, long-term investment in technology, right? Yep. So, if you think about where China's gone and the old sort of they're just a manufacturer, the advancements in technology have been there. We've seen it. We've seen it with things like DeepSeek. We've seen it with things like the EVs and so forth. But they've recognised that is sort of where the growth of the future lies for China. So they have made targeted long-term investments in that part, for example, in other infrastructure projects. So beyond sort of, I would say, the arguably the shorter term, more sugar hit sort of initiatives, which are important sometimes to stabilize markets in the short term. It's part of a broader scheme, I guess, to build confidence in markets and to create a more sustainable pathway to growth. It's part of a broader story. I mean, even if you think about some of those other policies, one of the interesting things they've also implemented is for state enterprises and sort of government entities. One of the sort of success metrics they've implemented for those is an ROE target, a return on equity target, which is quite interesting, right? Because if you think about that, it's not then moves the dial from just let's just gather assets to actually, are we doing this in a sustainable, profitable way? So it's a lot of sort of different things that I would say is more gradual, right? So again, rather than the big helicopter money coming in, which you're going to get that sugar hit. The markets are probably going to like that for a short period of time, but how sustainable that is. So it feels like this time round, there's certainly more to do. Yeah. The more to do, like the market wants to see more, absolutely. but it has been more targeted. So I think that has been a notable difference from previous cycles.
Well, the market's up just on 20% year to date. I think the SSE composite versus S&P 500 about 13% year to date.
Yeah.
I think to that point though, it is interesting. We have noticed how they target industry, and so renewable energy is one. EV cars is probably the most relevant right now. Target industry. And then make it hyper competitive within the industry, give them subsidies, pour cash in, but then say to everyone, all right, guys, you need to compete with each other. And that's why you have now this like huge influx of EV cars hitting Australian markets that are ultra cheap. Yeah. They're profitable companies. BYD is now taking over. It's pretty interesting to see, to your point, like targeted approach to building industry in China.
Absolutely. And it's interesting if you look at using the EVs as an example, even in the European market, and obviously Europe has gone down the path of sort of renewables and embracing sort of EVs more generally. And you think about these sort of your traditional powerhouses of automotive industry, whether it's Germany or France. I mean, France has effectively capitulated and so they're not going to be able to compete in the EV market. And they've actually sought to sort of have a partnership model with China, whereby China would produce some of their EVs in France, for the French market and markets beyond. So it's quite interesting how that whole market has evolved.
You mentioned valuations as one of the driving factors for sort of the performance over the last sort of 12 months or so. So let's dig into that a little bit more. Where do Chinese valuations sit compared to other markets? There's a lot of chit chat at the moment about the AI bubble and what we're seeing in the mega caps over in the US. So as Aussie investors who can easily access US tech, like how should we be thinking about China positions in our portfolios and how does it compare from a valuation?
Yeah, sure. So if we start with valuations, so China for some time, and on aggregate, the Chinese market has been, if you look at things like P's, for example, I think it's trading around 9% at the moment. And if you look at the US, it's sort of at the upper 20% mark. So on a pure relative valuation basis, China still looks cheaper. Now, there's always a caveat around valuations because you go, well, why is something cheap? It's cheap either because it's bad, or actually, things have been oversold and there's bad, but there's also some good. So we're in the camp that there's bad, but there's also some good. And if you sort of think about what's happened to the Chinese market over the last couple of years, about 2 years ago, you had that big sell-off, and it didn't matter which part of the market you were in, whether you were a good quality company with good management, with good balance sheets, through to a more speculative type of company, everything got sold off, right? As those capital flows came out, everything got sold off. So valuations have been certainly depressed, but we are sort of seeing that there are, you got to be picky. Okay, so that's number one. You got to be selective. Do you necessarily just want to buy the whole market? We would argue not. You want to be selective on where you go. And there are parts of the Chinese market that, from a pure valuation perspective, still look cheaper than relative to some of the developed markets, but they've also run pretty hard. So some of the tech names in China have also run pretty hard. Probably not as hard as some of those US stocks, absolutely. But it's really about picking the eyes out of those individual stocks. And that's sort of what we've been focused on. And even if you look at some of our positioning in some of our strategies, it's a very interesting mix of idiosyncratic sort of exposures tapped into different parts of the market. So things like, you probably want to avoid those heavily regulated industries that are maybe very much exposed to some of those trade risks, for example. So you've got to be cautious, but the opportunities certainly we think are there.
Yeah, we'll have a chat about where you guys are finding opportunity specifically towards the end of the ep.
Yeah.
And I think you're right. Like markets like China and emerging markets are where active management certainly plays a part, because taking just the broad exposure, while obviously it's been performing well this year, I think over time active helps. I want to talk about the DeepSeek moment you mentioned, early 2025, that really sort of rattled markets. For listeners who aren't aware of it, what was the DeepSeek moment? And I think what did that do to markets' confidence in China from like a growth perspective? Did it help improve market perception, or was it more of a worrying take?
Well, I think initially the market was shocked, right? Because everyone knows, if you think about sort of some of the developed companies, the sort of growth in AI, your chat GPTs of the world, stocks like NVIDIA that have invested, billions of dollars in terms of their technology and so forth. And, DeepSeek, so for the listeners that aren't as familiar, DeepSeek was effectively an AI engine that came out, I think. And so that in itself wasn't sort of the big deal. The big deal was that China developed this at, arguably a fraction of the cost, and weren't accessing some of those big sort of GPUs
the chips.
and like the chips from NVIDIA, for example. So the market was going, okay, let's sort of.
How the hell did that happen?
How did that happen? Like we've been investing billions and billions, and these guys have just gone and created something that's competitive to what we have at a fraction of the costs. And so when you saw that, a lot of these big, the Mag 7 names notably plummeted, because it was like suddenly, the whole sort of reason of being was like, okay, well, what's going on here? Yeah. So that's initially what happened. But I guess the broader term implications is there is certainly a technology race, right?
Yeah.
And it has put China on the map, so to speak, in terms of the perception of China as being actually a technology powerhouse, which it absolutely has evolved in that tech space materially over the years, right? So that old adage that it's just the factory of the world maybe is a bit of an outdated concept. If you look at some of those technological advances, whether it's in the field of AI, whether it's in other areas like the EVs, for example, as we talked about. So absolutely, it was a bit of a game changer, and you can see that there is an element of nervousness, certainly from competitors. So it's how now that the sort of shackles are off, so to speak, in this call it the AI race, it's how do you play that, right?
Yeah.
Like if you're regulating, how do you approach that? Maybe if your competitors aren't as regulated as much, because then it's like who's got the advantage then, right? So time will tell. We certainly don't know the answer as yet, but certainly it's put China on the map, and you've seen that in some of this tariff activity as well, where maybe in terms of China's ability to export some of this AI technology and some of the chips they're developing as well, whether there's going to be sort of tariff implications there, which there's some noise around that as well. But certainly in terms of the broader theme, they're on the map in terms of tech.
Let's talk about tariffs, because at the time of recording, we had Trump 4 days ago come out and say he was going to put 100% additional tariffs on China because they have tightened up export controls around rare earth equipment and the like. Over the weekend, he then said Xi Jinping's a good man and had just made an honest mistake. And I guess the rhetoric from him and JD Vance is that they'll probably be a little bit more open to negotiation and the like. Yeah. They're also currently in a trade truce, I'm pretty sure, till some point in November, 1st of November.
Yep, that's right.
So there's a lot happening in the tariff space. How much of the tariff conversation is impacting, in your view, the market at the moment in China? Like, does the geopolitical stability really become a driver for the underlying performance of these companies? How are you just generally thinking about what's going on from that point of view?
I think generally in terms of tariffs, obviously it's important, right? Like it does have implications more broadly, particularly for companies that are very much exposed to the export market in China. But I think the interesting thing is, this isn't a new thing. This tariff discussion has been going on for some time. And if you think about what has evolved over the years now, is even if you think about trade routes, it's not as if sort of things have stood still and people are just sitting back and waiting for the next tariff announcement. Like you have seen trade routes reconfigure as well. Yeah. So interestingly, like you've seen, for example, Mexico become one of the biggest trade partners for the US. Yeah. But you're seeing Chinese goods go via Mexico, then into the United States. So like the market is dynamic and it recalibrates, right? So it doesn't stay still and just sort of wait for the next hit on the head with a hammer, So we have seen a bit of that. And that's not to say the tariffs don't have impact. They certainly do. But I guess it's too early, with the latest announcement that you sort of mentioned. I know there's sort of active sort of negotiations at this point. So you can only go by what's happened in the past. And in the past, basically, you've seen big announcements and then generally those have been sort of moderated to some degree and there's some kind of sort of agreement reached. So jury's still out, we don't know, but, you get the sticker shock and, you see markets initially pull back and then sort of, again, precedent, you sort of have seen then markets sort of stabilise as you get more detail. So I think it's probably again, I'd probably take that approach and say, let's see where this goes. Like China hasn't stood still in terms of what they're doing and how they're working with different partners, not just with America, but also outside of the America.
So then how does that flow through to the decisions you make when you're looking at opportunities in China? Like, with so much announcements to be made, no understanding of what the implications are going to be. Where are you looking for opportunities at the moment? Where are you confident there's opportunities? And are there sectors or areas that you're just sort of saying, no, we're not going near this at the moment?
Yeah, it is a very much a stock by stock battle at the moment. So, some of the areas where we have been focusing on is some of those consumer names, particularly those consumer brands that are very much tied into the local domestic market. Now, the reason being is one is it does give you a bit more buffer in terms of some of those exogenous risks, but also the Chinese consumer has evolved, right? So if you sort of think, several years ago, typical Chinese consumer was maybe a bit more sort of aspirational. They'd want to buy the big sort of Western brand, et cetera, and so forth. But what we have seen evolve over time is that a lot of the local brands have gained a lot of traction in the domestic market. So the Chinese consumer is very happy to maybe buy a pair of sneakers or a Chinese brand, for example, compared to maybe a pair of Nikes, right? So that has been a shift. So, for example, one of the stocks we have in the portfolio is Anta. So a lot of people, maybe that means nothing to a lot of people. What is Anta? But effectively, it's a sportswear company. Within that, they do own different brands like Fila and a few other sort of well-known brands. I think one of them is called Jack Wolfskin as well. So there's a couple of different brands they own and marketed within the Chinese market and outside of the Chinese market. But that's been growing in terms of consumer demand quite considerably over time, and we think there's more to go as they sort of expand into that domestic market. Another interesting one, which is certainly not a big position at the moment, but it is an interesting one that we've been looking at, is a company called China Resources. So the name is a bit misleading. I mean, I think if you say China Resources, people think mining, but it's actually a beer company.
Oh, right.
So they...
Are they big beer drinkers?
Well, this is, again, a shift in the consumer appetite and consumer behaviour. There has been a growing demand for beer, and that company owns its own domestic brands. I think one of them is called Snow, but they also do license and produce like Heineken, for example, for the Chinese market. So again, you can see there, look, very sort of specific exposure and very much tapping into that sort of domestic play. So I guess the main thing is we're not sort of trying to be thematic in terms of how we're investing. We're not sort of saying, well, here's an AI theme, let's just pick all AI stocks or whatever it is. It's very much picking those companies that ultimately they do have strong balance sheets, strong sort of return on equity, good management in place where we see upside. So there's some interesting names, and I think it really is then about position sizing as well. How are you taking risk? So again, within a broader portfolio, what role does China play? That's important to consider. Obviously, it's not going to be 100% of your portfolio. It is a higher risk part of the market, so you've got to manage that accordingly in terms of your weightings. And then also within a broader Asia portfolio, similarly, how do you sort of take those positions? How do you sort of risk weight those appropriately? I mean, they're all sort of important considerations, but there's some examples of some of the stocks we've had. Another stock we've sort of had which is in our top 10, it's Zijin Mining, which is a gold company, which has benefited obviously from the gold price going off. For any sort of Sydney siders here, there's
the lines in Martin Place.
There's a line up in Martin Place in terms of people buying gold. But so look, I guess the main story here is very, very bottom up, and very stock specific.
No, I think that makes sense. So it's actually quite a difficult market for us Aussie investors to get exposure to. So what do you think is like the smart way? There's direct exposure, A shares, H shares, I think, Hong Kong. You can buy the ADRs through US markets. There's ETFs, like active managers. How do we think about the trade-offs? What is, for Aussie investors, just the best way to get exposure?
Yeah. So like when we invest in China, so you mentioned some of those instruments like ADRs, Hong Kong shares or A shares and so forth. And each have their pros and cons. And like, you know, shares listed on the Hong Kong market, obviously in terms of good governance, liquidity.
Yeah.
Absolutely, we do take that path. But then some companies don't list across those different sort of vehicles. For investors out there, there are numerous ways to get access. So you can either invest in a China fund, you can invest in a broader Asia fund, which has some exposure to China, or you can invest in, call it a broader emerging market fund, which is part of that, will probably have some exposure to China. There's different ways. It depends how much exposure you want. And then in terms of the vehicle, you know, again, you can go via a fund, you can go via an ETF. And again, within ETFs, there's different options. There's passive options. So basically ETFs that look to just replicate the market, through to active options. So we, for example, do have some Asian equity capabilities that are offered as an ETF, but also as a fund. So it depends on how people want to access that. Obviously, if it's an ETF, you can access that on exchange, which is convenient for a lot of people.
To be specific, it's the Fidelity Asia Active ETF that you're speaking of.
Yes, I am.
Ticker, I'll give it the plug if you don't want to. The ticker is FASI. I think it's 20 to 35 stocks across Asia, not just China.
Correct. So it's a concentrated portfolio. At the moment, from an index perspective, if you just look at sort of the broad allocation to China, it's roughly around 50%, which is sort of akin to the index, maybe a little bit more. But if you look at the underlying positions, it's very targeted. So you mentioned that portfolio has around sort of 20 to 30 stocks, so it's very concentrated. So very active in its approach, and so very focused in what we want to sort of achieve and the types of companies we want to invest in.
Yeah, nice. So Fidelity have been in Asia for 50 years. You've been on the ground in Hong Kong.
Yep.
How does, I guess, having analysts on the ground physically in those markets change the way that you approach putting these funds together versus if it was someone here in Australia, New York, or the like?
Yeah, I think that is a real sort of strength in terms of having resources on the ground within the various regions, and China in particular, because I mean there's so much that impacts the Chinese market. It's obviously having close connectivity to the you know, the companies, being there face to face, meeting the companies face to face, but also sentiment, getting a good sense of sentiment, and also a good sense of policy direction as well. Combine all those things together, and then having analysts in the space that obviously have the language skills and understand the culture. You know, so it's not one thing, but I think a culmination of things that we think that, you know, having those analysts on the ground give us you know, an added layer in terms of our research, and it gives us sort of added confidence, I guess, if we've got analysts that are sort of there on the ground covering that market.
So for people that are thinking that China, Asia more generally feels like a compelling opportunity, and, you know, thinking about investing through some of the active ETFs that are available, what's the bear case? Like, what's the risks that we should be thinking about? Is there anything that you're particularly keeping an eye on that you think could derail the turnaround thesis that we've been talking about?
Yeah, probably the biggest risk we'll say is policy missteps. So, you know, we talked about some of those initiatives that China has taken. So if you saw, for example, some of those policies just suddenly being wound back, or a shift in direction, or a lack of commitment, ongoing commitment to policy, that would be a red flag for us. We'd want to sort of get a really good understanding and comfort with that. Understand the regulatory environment as well. I mean, and again, you've got to be close to that, because that can change, and we have had instances in the past where certain sectors, the regulation around certain sectors has changed rapidly. So if you're invested in some of these sectors, you were adversely impacted basically. So you've got to keep an eye on those other factors that, you know, and certainly if those things went the wrong way, they could, you know, derail some of the positive steps that have been taken. And then more broadly is geopolitical risk. Now, it's not sort of unique to China, but we are arguably in a period where it feels like geopolitical risk is heightened.
Yeah.
Not only with tariffs, but with other things, with other conflicts that are happening around the world. So they're probably the key things we would be looking for, and if and where the risks are. And so you want to be rewarded for that risk. And so that's one. And secondly, you've just better be conscious of your position sizing, right? So if you are investing in a high risk part of the market, and China is a high risk part of the market, then as part of your total portfolio, just being cognizant how much are you allocating there and making sure it's in line with your own sort of risk objectives.
Not all in on China.
100%, yeah.
So for listeners, what's one thing from this conversation that you think they should leave with when it comes to the China's opportunity right now?
I would say look at the trend. So you want to see, as I mentioned earlier in the discussion, is you just want to see data show improvement. Things like property price stability, things like consumer. Is the consumer sentiment improving? You want to see improvement, and that's what to watch. So that's what I'd be looking at, is just seeing is that data holding, and is that data improving? And if it is, then that's a good sign.
Love it. Well, Lucas, as I said, I think this part of the market, emerging markets, Asia generally, is where active managers can certainly provide value to the portfolio. So for anyone listening, a reminder, the Fidelity Asia Active ETF, the ticker is FASI. We'll put a link in the show notes so you can have a look at the fund page to see if it's right for you. But it gives a breakdown, top 10 holdings, sectors as well. Gives you insight into what you offer. But Lucas, as always, it's an absolute pleasure. Thank you so much.
Thanks for having me.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.